we're looking forward to discussing and seeing your presentation as well on the topic of how innovation investments drive financial success in a business. So can you start by providing a brief background of yourself?
Yeah, I'm happy to be here, and thanks for inviting me to talk today. My background, I'm basically an electronic engineer. Started out that way and worked up through project management levels, that kind of thing, and transferred to Hewlett-Packard in 1973. And I was with Hewlett-Packard for 20 years. Worked a number of different, almost 20 years, by the way, were in R&D. So I worked at a number of different R&D management levels, and eventually ended up in Palo Alto as the director of a corporate group. It's called corporate engineering, but we turned it into an internal consulting group that was responsible for improving HP's R&D performance worldwide. And excuse me. I did that, we did that fairly successfully for a few years, and then I decided to try to show the executives when they came to review us how much we had impacted HP's bottom line. And I sent some people out to get the numbers, and when the numbers came back, it was kind of a nasty surprise. It turned out we couldn't show any improvement in HP's bottom line because of the work we've done. We could show that we'd improved R&D performance a lot, but somehow that did not end up translating into financial success for the various business units. So we did some more looking into it and found out that the problem seemed to be that where executives interacted effectively with their new product programs, they were very successful in improving the financial performance. Where the executives were not paying much attention, they didn't have much success impacting financials at all. And the difference seemed to be how the background of the executives. And one of the things we discovered was that HP's executive training didn't spend any time at all on the question of what do you teach executives to make them successful in managing their investments in new product innovation. So we pointed this out to the executives, and as was kind of typical in HP, they just turned right around and gave me the assignment to fix it. So I had that assignment for a short time, but I left HP a couple of years later and started my own consulting company. But I carried that question with me because it turned out to be pretty hard to answer. What do you teach the executives? And that's where this Paterson Hartman model came from. And that's really kind of what it is. It is that package of information you would like every executive and every leader of innovation at any level know and possess its common knowledge with their peers. I ran my own consulting company for 13 years. It was Innovation Resultants International. And I thought I was retiring in 2006, and I closed that one down and launched into writing a third book on how to manage innovation, and that carried me on into my current career. Among other things, right now I'm teaching at Stanford a course called Managing Innovation, and I use my third book as a text.
Well, this is interesting. Can you talk more about what is the Paterson-Hartman model?
Yeah, let me, I have a few slides that will help with that discussion. Just a little bit of background, though. In words, it's a generic. It's a description of the generic system that links innovation investments to financial performance in the business. What we have identified, and first of all, I want to mention the Hartman in Paterson-Hartman model is George Hartman. He was a mathematician at Xerox. Became acquainted when we were working with Xerox, and between the two of us, we put together this mathematical model, and it became known in the literature as the Paterson-Hartman model. And he contributed a great deal to the mathematics of the thing because that was his strong suit. but it defines the principles and quantitative relationships that govern the performance of the innovation system. It also includes the qualitative performance drivers that are essential to system success.
Can you,
It's another important aspect of it, though, is that it's a perspective on innovation as a business process that lines really well with one really important example, and that was the Hewlett-Packard company back during the 70s and 80s and 90s, when they were probably the world premier product development, product engineering company. So the Paterson Hartman model was very much centered, very much aligned with conditions that I got used to in HP. So let me show you that generic system that I'm talking about. Let me know when you get that up on the screen.
yes, I see the innovation systems elements.
Yeah, good. Okay, this is the system. Though it consists of a positive feedback loop up on the top, and the executive leadership that keeps that moving in the right direction down below. There's two basic parts. To describe the system, I like to start with customers. They're kind of should be the focus of any innovation effort. And the objective, of course, is to send them delivered value that they just can't resist. And they're willing to rip their wallets out and send you money in the mail, which is its revenue stream. This is a generic model, and any business that tries to use it is going to have to tune it to their own business model. And in some business models, just thinking about customers is too simple. In some business models, you need to include the users as part of the picture and understand the relationship between customers and users that will create the value proposition for the customer. The second part of the system is operations. And operations is all of the functions that it takes in a company to deliver value to the customer. In a typical manufacturing company, for instance, this would be sales, it would be manufacturing, it would be customer support, and maybe some others. And so that's how you think about operations. The objective of this part is to take new information from the innovation engine and transform it into new delivered value for the customer that's so compelling the customer will send this revenue stream back. Now, the third element, of course, is the innovation engine. And most people, when they see that, they say, oh, that's the R&D department. But it's a lot more than that. As we'll see later, the R&D department, the innovation engine, involves product marketing, it involves business development people, it involves technologists, researchers, product engineers, and a lot of people. So it's a very cross-functional effort. And when the revenue stream comes back and funds these activities, you form a positive feedback loop. And so that's this whole upper part is that feedback loop. Now, the executive leadership team are the people in the business unit that have span of control over everybody that works in this part of the innovation engine. And they have a number of key roles that they play in making this whole system successful. So they're a key part of the system.
And why is it useful?
Well, I'm not quite done talking about it, so I'll get to that as soon as I finish the description.
Okay.
The model, first of all, the model considers investments and revenues, and I've magnified the investments times 10 because otherwise they're too small to see. But it starts out with an initial investment wave, and here it is. It spans 4 years, and it grows up, and this is what funds the innovation engine in the first round. Eventually, that causes a revenue wave to occur out here in 2001, and that brings money in, and the loop is closed. Now, this leads us to the first growth driver for the system, and that's called innovation gain. And that's the number of dollars that every dollar invested in innovation creates. New revenue created by every dollar invested. And it's typically a number, $10 or $12 per dollar invested, something like that. But that's the first driver of this thing. Here's a second wave that comes in, and you see that the revenue wave that it creates lays down on top. And if you run this forward in time, you get a simulated performance. It looks a bit like a business that's gotten itself into a nice exponential growth here. The interesting thing about this model is it shows the time relationships that affect innovation in a very important way. Here's an innovation wave, this dark black bar here, that creates a revenue wave. And then the early part of the innovation cycle, we may be doing strategic things and making strategic decisions that influence this entire development activity. And this would be for a collection of products that happen to get introduced in this 2008. The revenue wave for those products extends clear out to 2012 in this example. So things that we do back here, the decisions we make, have an influence on the product that gets created and then the financial result of that product that continues to clear out here. So this is the first way I've found to show executives that what you do here really affects the future of your company out here in a very important way. And these decisions are critical, and you can't ignore them. So it's a way of getting executives engaged with the fact that, oh my gosh, the future of our company is being formed right out here. And it lasts for a long time, so we've got to be careful with those decisions. Now, the second growth driver is innovation intensity, and that's simply the annual investment in innovation that you do each year divided by the annual revenue for that same year. So it's the size of this stack of bars divided by the size of this stack of bars. So those are two of the drivers. There's one more. Excuse me. And that again is related to the investment wave and the revenue wave, and it has to do with what's the time delay between when I invest and when I get the revenue that I'm looking for. The Paterson-Hartman model shows a way of calculating the effective lump sum investment that has the same mathematical impact as a distributed wave. And likewise, you can do the same with revenue. A lump sum revenue timed properly will have the same mathematical impact as this distributed waveform. And so you can calculate the effective time delay, this T term here, time delay between an investment and the revenue that it creates. And that's the third driver. If you know those three things, if you can estimate them or something, here is the innovation gain, here's the innovation intensity, you multiply them together, you get the x-axis position. The y-axis is the revenue growth rate, expressed as a fraction. And these curves are the various time delays between the investment and the revenue payback. If you use an example here, it comes up with a revenue growth rate. If you multiply these two together, you get 1.5. You plot this at the right turn time, which is just on this side of the 2-year curve, and you come up with about a 22.25% growth rate. That's the part of the model that allows you to make decisions based on quantitative analysis. If you can figure out what ballpark you're working in this set of curves, you can make good decisions. For instance, if I delay a project a year, it's going to take me down here. And instead of 22%, I'm going to be down around 12%. So you have a quantitative basis with this model. Here's what goes on inside the innovation engine. Like I said, there's It's cross-functional. There's market opportunity discovery and technology opportunity discovery. This will be product marketing, business development people, and technologists. And strategies created, product concepts are validated. You get roadmaps of products and services and roadmaps of technology development, and that triggers programs over in here. The purpose is to figure out how to sell and support a new product and also how to implement and test it. The front end is a strategy, and it doesn't cost very much. It only uses a very tiny fraction of that overall investment wave. But it has a huge influence on the innovation gain parameter I talked about. This is where success is really born. Over here in development, that consumes most of the investment wave, and it has the major influence on the turn time parameter that we're talking about. Now we talked about the executive leaders and their roles. Well, their role is to fund this activity, to inspire the right kinds of work to be going on in the front end, to guide it, and to balance it between marketing and R&D, to balance it between strategic and development, and to improve it over time to keep it competitive. And there's one last slide here, and that is the qualitative factors that differentiate best-of-breed innovators from the rest. They're labeled level of involvement, feelings of effectiveness, and energy level. And basically, the spectrum of performance runs from a burned-out workforce clear up to what we call fully engaged. And the three factors are level of involvement, are the innovation professionals enthusiastically involved with their assignment, or are they detached, maybe even cynical, and grumpy about the fact that they have to do such meaningless work? Are they feeling highly effective every day when they go home, happy with the progress they make, or do they feel completely ineffective, know that the project's going to get canceled before it comes out, or something like that? And then finally, energy level. Are they fully energized and working hard and ready to do it again the next day, or are they just plain exhausted? So if you move people towards this upper corner on these three axes, you eliminate burnout and you will improve the innovation output tremendously. And again, here's the role that the executive leaders play in creating this chemistry that sets these conditions. That's the model. And I guess we're ready to move on to the next question. Would you mind that you had?
Oh yes. Yeah. My question was, how is it useful?
Well, it creates a comprehensive intellectual framework for improving innovation performance. So what I mean by comprehensive is it spans the whole range of important aspects of business, the strategic, the engineering, the motivation and morale of the employees, and it above all, it includes the executives as part of the system. My experience as a consultant was that in many companies, the executives really didn't see themselves as part of the innovation activity. That was really the domain of the R&D manager. And I think that's true even today. This model highlights areas of performance gaps and the root causes of those gaps. It provides qualitative and quantitative principles that improve decision quality. And let's see if I can do this. And it provides, I think one of the most important things it does is it provides innovation leaders with kind of a periscope that allows them to see beyond their inherent learning horizons. It was Peter Senge, I think, that taught us about learning horizons. If something happens too far away geographically, or if it happens too far out in the future, we can't discern cause and effect, and it breaks our ability it breaks that learning loop. And this model gives people perspective and some mental models that allow them to see over those horizons.
And can you talk about how this can be used effectively?
Yeah, the most effective way we were able to apply this when I was in the middle of my consulting career was to engage a business client at the executive level and convince them that this was worth learning about and to allow us to put on what we called an executive seminar. In a more involved version of that, we would not only do a seminar, the people who would be in that seminar would be the executives, leaders themselves, but also all of the middle managers and anybody that had anything to do with the innovation process in the enterprise. There would be some key individual contributors in there as well. I just did one a few weeks ago, and they had most of the high-level individual contributors, all of the managers from the R&D lab, and they had the executive staff of the enterprise in the room for a period of time. I mean, and in the most effective implementation of this, we actually have done workshops at the same time, concurrent with the seminar. We teach a bit of seminar, and then we go into workshops and let people talk about how they're doing it, how it compares with the model, and where the weaknesses might be in their current processes. But this workshop seminar activity provides a context in which people discover the low-hanging fruit that exists in their own operation. Those opportunities for improvement are really not that difficult to take on, but they will make a tremendous difference. The elements of the model work to show people how things should work, and quite often this highlights how things are out of kilter in a way that can be easily corrected.